Hi, I'm Jamal Khan, CEO of Churchill Mergers. Today we are cutting through the noise to explore one of the corporate finance's most strategic tools, the reverse takeover or RTO. If you're a growing company considering going public but dread the IPO grind, this episode is just for you. So I'll explain exactly how RTOs work, when they make sense, and share a real case where we helped a professional services firm list in half the time of a traditional IPO. So exactly what is an RTO? Picture this. So instead of filing mountains of IPO paperwork, you merge with an already listed company, typically a dormant shell company with a stock market listing but no real operations. So through this merger, your private company's shareholders gain control, your business replaces the shell company's operations, and almost overnight you become a publicly traded company. Very, very powerful. So it's like using a secret passage to reach the public markets, much faster, with fewer roadblocks, and often at a much lower cost. And I'll explain this later. So why smart companies choose RTOs from our deal experience? Here are 5 compelling reasons why it stands out. First of all, speed. So while IPOs take 9 to 18 months, our average RTOs completes in about 4 to 6 months. So when we guided the £18 million professional services firm mentioned earlier, they went from private to trading on AIM in just 22 weeks. Cost efficiency is number 2. So skip the 7-figure underwriting fees. A well-structured RTO costs typically 60 to 70% less than an equivalent IPO. So number 3 is certainty. So no last-minute IPO cancellations when markets wobble. The deal terms are negotiated up front. And number 4 is strategic flexibility. So public status lets you use share as acquisition currency, attract institutional investors, provide employee liquidity. Number 5 is quieter market entry. So avoid the IPO spotlight until you're ready. We once helped a tech client list via an RTO, then waited 6 months before doing their investor roadshow on their own terms. Very, very useful. So a real world success stories. Let me share how this played out for one of our clients. The company was an 18 million revenue professional services firm, strong niche in the financial compliance, needed capital for acquisitions. So the RTO advantage was, first of all, it was identified as a name-listed shell with 15 million cash. Number 2 was structured a merger, giving our client a 65% ownership. Number 3, negotiated key protections, so lock-ins for founder shares, etc. Performance-linked earnouts and board control was also there. So the outcome was listed in roughly 5 months versus IPO, which could have taken 14 months. Used the shell's cash for 2 bolt-on deals. Market cap grew from 25 million to about 42 million in about 12 months' time. So here are the pitfalls of RTOs. So RTOs are not for everybody. There are 3 critical watch-outs. First of all, shell company quality matters. We once walked away from a deal after finding undisclosed liabilities in target shell. So always review 3+ years of financials, maybe 5 years, scrutinize all legal histories, interview the former directors, carry out detailed due diligence. So there are regulatory hurdles as well. Exchanges scrutinize these deals. For our professional services firm client, we pre-cleared the structure with the FCA, developed a compliant partner remuneration plans. We created transparent reporting systems. Very useful. So investor perception, some funds discount RTO stocks initially. We combat this by selecting shells with clean histories, immediately engaging analysts, and setting clear growth benchmarks. So let's compare an RTO versus IPO by the numbers. Let's compare kind of the key metrics. So the timeline for RTOs is 4 to 6 months, whereas 9 to 18 months for IPOs. All in cost roughly £500,000 for an RTO versus 1.5 million for an IPO. Market risk is very low compared to an IPO, and you have control, whereas in an IPO the bankers have the control. Well, is the IPO right for you? So ask these questions. So do we need the brand splash of a big IPO, or just want efficient public market access? So can we handle public company reporting? So this is something you need to ask yourself. So for many growth companies, especially in tech, professional services and resources, RTOs deliver public status without the IPO headache. At Churchill Mergers, we have executed several RTOs and across different sectors, from professional services to medtech or innovators. If you're thinking about an RTO or going public, talk to us, give us a call, and I'll be more than happy to kind of guide you through and then help you look for that particular shell company or another company, and then maybe look at the options in terms of what your next steps should be. Thank you very much.